Hi, everyone. Thanks so much for joining. I can't believe it, right? Another month. We've got the non-farm payrolls today. But there is definitely something to be spoken about, sorry about that, for what's been happening in the markets more broadly. Just bear with me one moment. Close the door there. Sorry. Just to talk more broadly about what's been going on in the markets more broadly, because of course we've had that massive drop in Tesla. Let's jump straight in and share our charts. Great. So you are seeing here now, this is Tesla's chart. As you can see, a massive drop down. Look at that right-hand side. Now, I just want to bring you to this Tesla chart because if we look at the yellow line at the bottom, this shows you the rate of change. Now, I just want to highlight the fact that yesterday's 14% decline in Tesla share price, it was more than the 10% decline that we got in the aftermath on the 4th of April, which was in the aftermath of the reciprocal tariffs. And it is one of the largest daily losses in Tesla's entire history. So it is absolutely huge. Now, if I just change this from last price to market cap, because this is actually quite important, I think. Just bear with me. We're just getting it up. Then what you could, current market cap, there we go. What you can see is that Tesla had been in that 1 trillion club. If you just follow my pointer here. So we had been above $1 trillion in valuation for Tesla. Yesterday's decline was huge amount. It was over $200 billion. So we went down, we've fallen below that 1 trillion level. We're still, the company is still worth 900 billion-ish, thereabouts. And we have essentially seen a huge decline in market cap and the valuation of Tesla. Now, do I think it's going to get back above that 1 trillion mark? I've been asked that question so many times today. I can't even imagine, which was not what I expected. And I do not think that actually we will. And the reason why I don't think we will is because there's now this risk premium in Tesla's share price. So whilst Tesla is rallying 4% in the pre-market, and I do think that we could see some upside in the Tesla share price today, because remember, Elon Musk has said he's going to enter into a cooling off period with Donald Trump. I don't see us going back above the 1 trillion level. Now, because we've got this premium in. Now I'm going back to price now. So we're going away from market cap, back into price. So we fell below the $300 mark. Can we get back above 300? Yes, we are going to more than likely get back above $300. Do I see us going back to 350? So the most recent high from the end of May, I actually don't see us going back there. And I think that the main reason is this political risk premium. That, if we look at the two biggest declines that we've seen in Tesla's share price in at least the last 5 years was yesterday, and it was on the 4th after those reciprocal tariffs. What does that tell me? That tells me that politics is quite negative and a bit toxic for Tesla's share price. And I think now that we've got this public spat, now that we know that Elon Musk is willing to take on Donald Trump in public, although he has said that he's entered into a cooling off period now, which is why the stock price is rallying today. But the fact that Donald Trump is quite personal, the fact he can be unprofessional at times, suggests that this political risk premium is going to be baked into Tesla for a while. So I'm not saying that it's not recovering. In fact, it is recovering. It's recovering in the pre-market, and I think we could move, maybe retrace half, even 3/4 of that move that we saw yesterday. But I'm not 100% sure we'll get back into the 1 trillion club. I don't believe that we'll get back to those 350 highs in the share price. Now, leading up to payrolls, where are we? These are European stocks. Remember, US stocks, they're not open at the moment, but I'm just circling these with my pointer here. They're a bit near, right? The markets, they are kind of, small gains, apart from the DAX, which is lower on the day. And we had some mixed performance in Asia as well. Chinese stocks were down a bit. Japanese stocks were up a bit. So we're not seeing any clear direction. What else is really important leading up to payrolls? Well, of course, the dollar. The dollar has been very, very weak. I'm just showing you spot returns here for this week for the US dollar. It's actually trading somewhere in the middle of the G10 FX space. So it is gaining, the dollar is gaining ground against the yen, the Swedish krona, and the Swiss franc. So the yen and the Swissy, they've been tapering off a bit this week because of that move back, the move away from risk aversion. So less need for the yen, less need for the Swiss franc. Also, there's some reports that the Bank of Japan is going to go back to buying bonds. So that's another reason why the yen is so weak, and it is the weakest of the G10 currencies so far this week, or so far in June, I could even say. And yet the Canadian dollar, the pound, and the euro, they're all up against the US dollar, not by a huge amount this week. In fact, the euro is actually now flat, just flat, and the pound's only up about 0.2%. So what this means is that we've seen a bit of a comeback in the US dollar. We're just going to look at that dollar spot index here. And then we're going to look at the data because it's coming out now in 4 minutes. So the dollar index actually at the highs of the day, look, above 99. If we just zoom out a little bit, we can see that whilst it looks great on a daily basis, the dollar is still very much in the doldrums. Now, this is the dollar index. So it's the dollar against a broad number of its trading partners, the euro obviously being the most important one. As you see, very, very weak. But we have picked up off those lows here. We are just extending those gains. It'll be really interesting to see how we react to this payrolls report, because make no doubt about it, recession risks are still a big fear for the markets. The non-farm payrolls report and the labour market report more generally, that's going to be a key test about whether or not the US will fall into recession. So make no mistake, this is going to be really important, and it's going to be a driver of markets, and it could be a driver of markets in the kind of medium term, so over the next few weeks as well. I just want to show you bond yields as well. Some people have been talking after everything that happened in the markets yesterday with Tesla, which also weighed a bit on overall US stocks, whether or not the US is having some sort of crisis, a bit like a Liz Truss style crisis, because there's also concerns about this budget bill. Well, we have seen yields rise, but not in any meaningful way, certainly not in the very short term anyway. And actually, I was talking to people about this. This is the 10-year yield. People talking about whether or not the US is in a crisis mode. Well, I would say that actually since 2021, we've seen yields move dramatically higher. We're not about 60 basis points now away from the highs that were reached in October 2023. So this is the 10-year US Treasury yield, which is considered a bit of a benchmark. So worth looking at where that goes. So we really aren't in a Liz Truss moment, is what I would say, because do you remember going back to the Liz Truss budget, we really saw 10-year US Treasury yields, US, not Treasury, sorry, gilt yields, UK yields. They really surged high. They were at the highest level since 1998. And in fact, they've maintained that strength. And they recently returned to that level, albeit at a much measured pace. So we're not in crisis zone, I don't think, anywhere in the bond market, although there is obviously a big focus on deficits and things like that. But certainly coming into this meeting, let's go back to that bond market. We are seeing US yields rise a little bit. This is the 2-year yield. This is worth watching because the 2-year yield is very, very closely linked to what goes on with the Fed and where the Fed will go. Right now, there's 2 rate cuts priced in. So if we see a very weak payrolls report, then that could weigh on yields. We could also see more expectations of greater cuts from the Federal Reserve. Now, we're about just over a minute now away from these payrolls. Let's just run through the data. So non-farm payrolls, the headline number, we're looking for 126,000. That's down from 177,000 in April. Private sector payrolls, well, that's 120. The unemployment rate, that's also really, really key, 4.2%. Remember, the unemployment rate tends to move very, very slowly. It is a lagging economic indicator. We've also got hourly earnings, and they're expected to edge down a notch to 3.7% for May, down from 3.8% in April. But overall, the big number to watch, I think, is going to be these payrolls. 126K is what the market is expecting, but we could obviously see some further weakness there. We could obviously see some further weakness there. So that certainly is worth watching. So we are now 30 seconds away from what's going on in with payrolls. So we're just waiting for that data. And remember, there are a bit of a word on the street now that we could see a slightly stronger number. I think that's why we're seeing that dollar strength. We have seen some weakness, or there was some weakness in other economic data and labor market data, but not quite yet. So we've got non-farm payrolls coming up. Should be any second now. Yes, 139K. So that is slightly stronger than expected. Let's check that unemployment rate. Stayed at 4.2%. And of course, the average hourly earnings. Oh, they rose to 3.9%. So that's really interesting. Stronger private sector payrolls up for 140K. So a big divergence there with the ADP, which is the private sector payrolls, report that was released on Wednesday, very, very weak, but we don't tend to see much of a correlation between payrolls and those. So 139K, but we did see a revised lower for the April number to 147K. So we really are seeing a bit of a downshift. I just want to click into that number so that we can look into the details just a little bit more. Just bear with us here. This is all coming up now, any second now. Yes. Okay. So we are, is that the April number? Okay, that's the April number. We haven't yet got onto the May. I'm sure that will be up later. But let's take a quick look at the dollar index. Let's go on to the daily chart so we can see exactly what's happened to this. So it's backed off a little bit from its high, but still above 99. We're going to have to watch that just a bit more closely. We're also going to look at overall equity indices, not too much movement there. To be honest, I don't see, so let's just go back to that dollar index. So we are retreating a little bit here, going back to that 99 level. I think it's not because of the May number. I think it's the downward revision in the April number that's been the big key thing. Now, for the unemployment rate in the US not to rise, you need job growth of about 200,000 per month. So we haven't been at 200,000 per month for some time. I just want to go back to, let's just go back to interrogate that number a little bit to see if we can, let's understand what is driving that weakness in the dollar. So if we just go onto the historical prices here, and we're just pulling that up now, then we can see exactly what's going on. And then I'll look at a few more currency pairs because they're always good. Okay, so we haven't been above 200 since since December. So for the whole of the year so far, we've been having these quite weak numbers. So that weakness that we saw in January, February, that was down to a few weather-related events, but we're not actually picking up the pace enough here. So that is going to cause a little bit of concern that the labour market is actually slowing down in the US. Let's take a look at this work chart. Now, don't worry, it looks very, very complicated. It's really not. It's interest rate probabilities. So here now, what do we have? So we've got about 3.8. So interest rates currently 4.5%. They're expected to fall to 3.8% by the end of this year, and we are looking at approximately kind of about two-ish rate cuts, for the rest of this year. So nothing too dramatic on the back of this, but I think it does show that there is kind of this weakness that's creeping in. Now let's take a quick look at what euro dollar is doing, because remember, we have seen the dollar back away from those highs. Has that led to a bit of euro strength? We're going to take a look now. It has, yeah. So we have seen kind of a knee-jerk movement higher in the euro, and we would expect maybe something a bit less in the yen, because the yen obviously has been quite weak and is weighed down by other things. Dollar yen had spiked higher. It's moving sideways. The US dollar. I think dollar yen is going to remain fairly strong, and that's because we've got this weakness coming through quite dramatically in the yen. Now I'm just going to zoom out on that dollar yen chart because I think it's worth it. Yes, we are testing the 50-day moving average at 144.5. We're just below that right now, but we have been testing it. Look for a weekly close above this number, so at 144.5, because if we get a weekly close above that number, that is quite a bullish development, certainly in the short term, that could see us go back towards that kind of 147, those highs from the middle of May, so from about 3 weeks ago now. Let's take a look at what the commodity space is doing as well. That's always worth watching when we have this payrolls data. Now, again, not too much movement. We have seen a lot of movement in energy, so just follow my pointer here. This is Brent crude oil. Are we ever going to get meaningfully above $65 per barrel? I'm not 100% sure we are. Not in the near term. There are just too many downside factors on oil. And the latest downside factor is obviously this slight weakening and softening in the US economic data and the labour market data. Now, do I think that we've got enough to spur a rate cut to try, which would potentially boost oil? I actually don't. So I think $65, that's going to be really, 65.30 we're at the moment, that's, let's say $65.50. Very, very tough level of resistance there for oil bulls. They might be a bit disappointed. Now let's take a look at gold. The gold price comfortably above 3,350. In fact, I'll bring up the gold chart because it's always so good to look at gold chart. It just gives you so much information about where the markets are thinking, where their head is at, and where, trends in other markets as well. Consolidation pattern in gold, but clearly we're above the main moving averages, which shows kind of an uptrend that's still in place. And we are consolidating this week so far, but we've got this this real lovely pattern here of a series of higher lows. So that suggests we're still in that uptrend. 3,400 is really knocking on the door. We're currently trading around 3,355 at 56-ish. And so we could potentially extend those gains. There's nothing in the price action from gold that suggests we won't, although the price action is quite minimal. Obviously, a weaker labour market is not particularly inflationary. So we could see, you could see some of the inflation premium and benefits from oil start to get taken away from there. However, I think if we look at it just a little bit more closely and a bit more critically for the oil price, or for the gold price, sorry, then I actually think if we look back at that data, we did see a stronger than expected wage growth. So wage growth is still a bit of an issue, which could tie the Fed's hands. And that might be one reason, just going back to this interest rate probability chart, why we're still only expecting those 2 rate cuts, and why actually just yesterday we'd seen interest rates about 3.8%, and now we've just gone up by about 1 basis point. So interest rates expected to end the year in the US at 3.81%. So still those 2 rate cuts priced in, because we're at between 4.25 and 4.5% for the for that, which is good. Now let's take a quick look at futures for the E-minis, because US markets aren't going to be open for just under an hour. E-minis, yeah, let's see where they are. Kind of moving around a little bit, really. We're not seeing too much excitement on these. We are making some gains. So we're up about 27 points. Let me just chart that for you. Just bear with me there. Yeah, so we are up slightly in the futures, US futures. Now that's to be expected, because we have seen some gains as well in the Tesla's share price. So Tesla expected to open by over 4% at this point, and we could, if you think about it, Tesla has been leading the Magnificent Seven since the stock market recovery began in April, and the tech sector has been leading the stock market recovery in the S&P 500. So the overall US stock market recovery has really been driven by what's been going on here. So I think that it's no surprise that if Tesla recovers today, then so will the overall index. Now, guys, I think I will, by and large, leave it there, because we're going to wait for the open. I do think there's a lot to talk about in terms of the payrolls. Of course, they are slightly stronger than expected, but it still suggests a softening, but nothing too dramatic. So the labour market isn't falling off a cliff, which is what we had expected. But we also have the fact that we had this big Tesla sell-off. So we've got another narrative that is driving market sentiment today, and that's going to really play out in stocks. In the dollar, though, I think it's maybe slightly weaker. A slightly weaker dollar, but by and large, this data is kind of more of the same. I don't think it changes any of the directions. I think yields now, there's probably a cap on how high yields can go in the US. There's also a cap on the US dollar. I think how high that can recover. I don't see it getting back up, the dollar index getting above 100, even though it's sort of trading around about that 99 level. And I think let's look forward next week. Let's look at that CPI data for the US, and that's going to be the next main driver. So thank you all so much for joining, and good luck trading for the rest of today.